Let's take a look at February MixMax. Before we get started, I want to review just a little bit about the cash flows categories. So let's recall, that we can finance with debt and equity. When we do that, when we issue stock or borrow money, cash will come in. We invest that cash in our long-term assets, our physical assets used for operations. Those long-term assets are used to generate revenue. And of course, we will incur expenses generating that revenue as well. And hopefully the outcome or the result is profits or net income. And if we are profitable, that will satisfy our investors and creditors and make them happy. So that basic business model is how our operating activities get classified. So if we were to break it into, these three groupings, financing with debt and equity would be a financing activity. So when we borrow money or issue stock, that's a financing activity. When we purchase our long-term assets or sell our long-term assets, either way, cash flow is coming in or out, that's investing. And then all of this other activity with revenue and also expenses, any cash received from revenue or any cash paid out for expenses, those are operating activities. So just a big overview of that. Okay, let's go on to our next page. I'm assuming you got at least this far on February MixMax. So, that's not going to capture my whole screen, is it? You could have already listed out your revenue and your expense accounts, maybe put dollars in for that. Also the changes in all the balance sheet accounts, I have entered those in. And one other comment I want to make, at this point in time, you should add all the credit changes, such as this 9,300, plus the 5,500, 675, 2181, and 6,200. You should have gotten 23,856. And then likewise, add up your debit changes, the 12,000, 9,400, 5, 1,900, 551, and again you get 23,856. If you do not do that and you're out of balance because you made a mistake putting in the changes, then this isn't going to work. You're going to end up out of balance as well. So from the get-go, make sure that your accounts are in balance. Okay, well, let's go and journalize. That step number 1 was entering the changes in the balance sheet. Step number 2 is to journalize your income statement. So the basic thing is, when we see revenue on the income statement, what's the related account over here on the balance sheet or accounts? Well, there actually are two. Sales has an impact on accounts receivable. It also can have an impact on unearned revenue. Now, given there were no changes in unearned revenue, and also you may have recognized and noticed there's no balances at beginning or ending in unearned revenue, so nothing happened in the unearned revenue account. Given that, all of this I only put 4,800 there. That should be 48,000, shouldn't it? All of this 48,000, let me correct that, all of that 48,000 had an impact on accounts receivable. And we know that sales increases accounts receivable. Sales on account increases accounts receivable. And we're just going to make the assumption if there's an account receivable, they sell on account. So we have a debit to accounts receivable and a credit to sales. Now I can go ahead and solve for the cash flow, right? So of revenue, I can solve for, what's the cash collected from that revenue? And that's an operating activity. Notice I have kind of put CFO, that means cash from operations. So all the operating cash flows we're going to put here. FA is for financing activity, so if there's any financing activities, we'll put them down here. And so far, we've not seen any investing activities for the MixMax case. Those will come later, but just not yet. So we could go ahead and solve for, keeping this in balance if how much was received in cash, and I'm going to make that in a letter that A. So I'll have the income statement journalized numerically. The cash flows are going to be with the letter. Okay, so if accounts receivable went up, that's because they sold more than cash collected. Well, how much cash did they collect? Well, 48,000 minus 9,400 is 38,600. So we just solved for they must have collected 38,600. So if they collected cash, cash would go up. So let's put that 38,600 over here and label it A. And also, I'm going to write a little description that is cash coming from our customers, or cash collected from revenues, cash coming from customers. So when we write out our cash flow statement, I'll know what this 38,600 represents. Okay, so I have a debit to cash for operating and a credit to accounts receivable. Also, before we move on, I just want to remind you, remember on these asset and liability accounts, the crisscrosses will equal. So 38,600 plus 9,400 equals this 48,000 and 0. Okay, let's move on to our next income statement account, cost of goods sold. So when goods are sold, if I see cost of goods sold on the income statement, look over here and think, okay, what's a related balance sheet account? Well, the account that represents goods is the inventory account. When we sell those goods, inventory goes down. So let's put that 21,000 on the downside. And so it should make sense. When we sell goods, the cost of those goods will decrease inventory. So it should make sense. And secondly, you should have a debit and a credit. So as we go through the income statement items, those two things should always occur. One, you should always have a debit and a credit that equal. And secondly, it should just make sense in your reasoning skills. Okay, so we know the cost of goods sold is $21,000. The balance sheet tells us inventory went down $5,000. So if it went down, that means they sold more than they purchased. So then we can solve for purchases. Must have been $16,000. I'm going to label that 3. It's really not a cash flow or an income statement transaction. It's just a transaction. And it's not a cash flow. So I can solve for, right, 5 and 16 is 21,000. So inventory goes up when we buy goods. It goes down when we sell goods. So if we bought $16,000 worth of goods, well, what was the other side of that? So the goods come in. That's what we receive. What did MixMax give up, right? What's the give and take transaction? Goods come in. What do we give up? Well, it could be that we gave up cash, because we do have to pay cash for our goods. But as long as there's this account payable merchandise account, that tells me MixMax purchases on account or on credit. So when they bought the $16,000, they also owed money for it. And that was the other side of that purchase transaction. So they owe money, the accounts payable will go up. So we have a debit to inventory, a credit to accounts payable. Now we're ready to solve for, what were the debits to accounts payable? Well, debits to accounts payable are good because we paid cash, right? It goes up because we purchase goods and owe money, and then it'll go down because we pay our suppliers. So while we're on the accounts payable, let's solve for, well, how much did they pay? So I'm just going to add these two together, and I will get 17,900. That's a cash flow. That's my second cash flow. I'll label it B. So they paid 17,900 cash for the goods. So if cash went out, put it on the downside up here, 17,900. Transaction B, and that is cash paid for merchandise. So actually to our suppliers of merchandise. But I'll just put merchandise there, and that's enough to remind us that was for suppliers of merchandise. So we have a debit to accounts payable, credit to cash. Fun stuff, isn't it? Most students just love this MixMax because it's, you start to see the reasoning, and it's just a lot of fun. So I hope you enjoy this case. Next one is operating expenses. Now for the MixMax case, we are to assume operating expenses are for salaries and utilities. So salaries and utilities. And that's an important assumption because that means we use those items and then pay for them later, right? A company will consume their utilities, then they'll get a bill and pay for it later. Employees work, and then we pay them later. So both of those mean that, so if I see this expense for salaries and utilities, I would expect some sort of payable account. There might be a salary payable or a utility payable. In MixMax's case, it's this accounts payable services. So it's going to go up because we owe money for salaries, we owe money for utilities. And we have a debit to operating expense, a credit to the accounts payable services. Once we know that, now we can solve for, in the accounts payable, well, what were the cash payments? If the account went up, that's because the expense exceeded the cash payments. So the difference in those two is $7,699. So if I add those two together, I'll get $9,880. So we just solved for cash was paid, $7,699, so decrease cash for that, and that was cash paid for services, utilities, and salaries. So I have a debit to accounts payable services, credit to cash, 7699. Fun stuff. Depreciation expense. So if I see depreciation expense on the income statement, well, what's the related account over here? So think about it. Well, when we have the monthly expense, that increases the accumulated amount. So accumulated depreciation will go up. So we have a debit to depreciation expense, a credit to accumulated depreciation. And there was nothing, right? That account is in balance. The crisscross is equal, so nothing else happened to that account. All right, next one, rent expense. Well, if I see rent expense on the income statement, what might be the related account on the balance sheet? So think about that for a little bit. Hope you recognize prepaid rent. Prepaid rent goes up when cash is paid in advance. It goes down when we use the rent, which is rent expense. So we have a debit to rent expense, a credit to prepaid rent, the account, right? The double T account is in balance, so that means no cash was paid. Next one, interest expense. So when I see interest expense on the income statement, what might be the related account over here? Well, interest payable, because we always pay for interest after it's been accrued. So interest payable will go up when we incur the expense. Okay, so I have a debit to interest expense and a credit to interest payable. And like all payables, it goes down when cash is paid. If the account went down, that means we paid more cash than the expense. So the cash payment must have been $450. We're ready for transaction D for cash flow. So we know cash was paid, $450 for interest. And I'm running a little close there. I'm just going to put an I to represent interest. So we have a debit to interest payable, a cash credit. So a debit to interest payable, and we're crediting cash operating activity for interest. Last one on the income statement, number 8, is income tax expense. What's the related account over here? Well, we owe money when we incur the income tax expense. So we have a debit to income tax expense, a credit to taxes payable. And that account is in balance. There must not have been any cash flows for it. Okay, then lastly, last thing on the income statement was net income. Net income was $9,300. Net income increases retained earnings. Now, how did we get it to net income? Well, that's from closing out revenue and all the expense accounts. So I'm going to enter in a debit to sales revenue for $48,000 and then credit all the expense accounts to zero those out. And then they'll have zero balances for the beginning of March. And that's what we want. Those accounts should have zero balances so we can start, accumulating those all over again. So I have a debit of $48,000, all of these credits. I would be out of balance by $9,300 at that point. We need the $9,300 credit over here. Okay, and now we can see our retained earnings is in balance. Great. Then we just look to see, are there any more cash transactions? because we have converted all the revenues and expenses to cash flows. And at this point, if I take what's in green, the $38,600, and subtract these three cash payments, I will get $12,551. Now, I need the account to balance, the changes to balance to this $12,000. So we're not finished yet. There had to be another cash flow because we want the net cash flows to equal $12,000. So we're going to go looking over here. What have we not balanced out? That nothing happened to long-term debt. This is in balance, it's in balance, it's in balance. Aha! Current portion of debt. Current portion of debt went down. Well, debt goes down when we pay for it. Now, that's the current portion of long-term debt. Cash flows with long-term debt are financing activities. So when I go to record the cash payment of $551 over here, I middled that D over here, should be E, transaction E. So I'm just going to write something like debt payment. So I have a debit to current portion, credit to cash, financing activity. Okay, and now we're in balance because we have cash flows from operations, $12,551, subtract this $551, and we get our overall change in cash of $12,000. And we're finished with the indirect method. Okay? All right. Now, on your next page, I want us to kind of look at, well, what's the big picture? You know, that was, most of you are going to, you really enjoyed those T accounts. They're very visual, and you like, the brain teaser that MixMax case brings with it. So it's a lot of fun. So let's kind of review for January and February MixMax. What have we really, in theory, accounting theory, what have we walked away from? Well, it's really driven home that we can, have sales on account, which creates an accounts receivable for the balance sheet, and then later collect the cash. Or it may be that we collect the cash first. If so, it creates a liability on the balance sheet because we owe goods and services. That's the unearned revenue account. And later, we provide those goods and services and earn the revenue. We've also learned that when we have cost of goods sold, that comes out of the inventory account. And then also, the other transaction that impacts inventory is purchases of inventory. When we buy inventory, that increases our accounts payable merchandise, and then later we will pay for the cash. We will make cash payments to the suppliers of the goods. Rent expense, cash is usually paid for rent in advance, and then later we incur the rent expense when we use it. Depreciation expense increases accumulated depreciation, but depreciation is never a cash payment. Right? Companies don't write checks for depreciation. We write checks, we pay cash when we purchase long-term assets, but we don't write cash to represent the depreciation of the assets. Operating expenses, like salaries and utilities, we accrue those in a payable and later pay the cash. Likewise with interest expense, it gets accrued in a payable and later we pay the cash. And the same for income taxes. We accrue that expense and later pay the cash. So what we really were doing in this case is that we would just take sales, we would weave it through those two accounts to get the cash flow. Cost of goods sold, we would weave it through inventory and accounts payable to solve for the cash flow. Rent expense, we would weave it through the prepaid rent to get the cash flow. Depreciation, it's stopped, right? It's stopped with accumulated depreciation because there's never a cash flow. Operating expenses, we weave it through accounts payable. Likewise, all of these last three expenses get weaved through a payable to solve for the cash flow. So we take the revenue and expense, weave it through these accounts to get the cash flow. Okay? And then that gave us net income, but over here, converting revenue to cash receipts, and all these expenses to cash payments. Those are all operating cash flows. Okay, so back over here on February, there are two ways of preparing the cash flow statement. Well, let's look at under the direct method. Let's take these numbers in green and see what those would look like. Okay, so under the direct method, don't look over here yet, just focus over here. So it's going to cover a month, this cash flow reports what happened for the month of February. And so we just list our operating cash flows. There we get our $12,551. We list our cash payment for the payment on our long-term debt. That gives us an increase in cash. We started with $11,000 at the beginning of February, and then you ought to go back to your balance sheet for February. You'll see at the end we had a $23,000 balance, so that'll reconcile to the balance sheet. Okay, so that's the direct method, and most of us really like it's fun to prepare it. It's also very easy to read. It's very understandable. Cash came from, customers. We paid cash for these various things. It's very clear what happened. However, there's another method that's an optional method, and it's the indirect method. And something like 95% of companies use the indirect method. So you really are going to have to learn the indirect method. But reading it is very, very complicated. You start with net income, we add depreciation expense, we add the decrease, and an increase in that account. We subtract an increase and a decrease in that account. And then that gives us, notice, the same cash from operations. So we still get the same cash flow from operations, but the content looks very, very different. Now for the financing activity, it's identical. I could have just copied and pasted it over here. It reads exactly the same. And had we had any investing activities, those would have been the same as well. So the only thing that's different between the direct and indirect method is how we report cash from operations. The net's going to be the same, but the detail will be very different. Okay? All right. Well, so here again, the two methods. Operating activities are going to be different, but the other two will be the same. So, given investing and financing are the same, I'm only going to focus on how to solve for cash from operations for the indirect method, because we've already done the one financing event. There's really 5 steps to it at this point, and by the way, by the time we finish the intermediate book, there'll be 6 or 7, but for now it's 5. It's really a reconciliation. It's really reconciling net income to cash from operations. So, this part of the operating activities, we're really just taking the income and reconciling it to cash from operating activities. So step number 1 is to start with net income. Then we're going to kind of clean up net income because we only want cash flows. So if there's any non-cash items on the income statement, we want to take it out. Well, we just talked about depreciation expense does not require a cash flow. So we want to remove it. Well, let's think about that. We have revenue on the income statement. We subtract expenses to arrive at net income. So since expenses are subtracted, if I want to remove an expense, I will add it back. So we'll add back depreciation expense to take it out of net income. The third step it is to remove any non-operating items because we only want operating activities. Well, it's possible on the income statement we might have gains from sales of property, plant, and equipment, or we might have losses from sales of property, plant, and equipment. So gains from sale of property, plant, and equipment, or losses from sale of property, plant, and equipment. So in that case, we have our revenue minus expenses. Gains get added in on the income statement. Losses get subtracted to arrive at net income. I mean, that's just your bare bones income statement with no appropriate classifications. Okay. Oh, I messed up there. Sorry, let me erase something real quick. Don't need to put that plus and minus there yet. Okay, so since gains are added in to arrive at net income, if I want to remove it, then I will subtract it. And likewise with the losses. Losses are subtracted to arrive at net income. So if I want to take it out of net income, I will add that back. And we won't see really any of this yet in MixMax till for a little while. Number 4, then we're going to look at the changes in the current assets and current liabilities and then arrive at cash from operations. So I'm going to go back to this screen. Okay, so let's kind of look at what's going on in that reconciliation. Step number 1 started with net income, and then since depreciation is never a cash flow, we add back the non-cash stuff. Now we didn't have any gains and losses. If we had gains and losses, we would do something with them as well. So we start with net income and then we tidy it up. Anything here that won't be a cash flow, we take it out. And then anything here that's not an operating activity, we take it out as well. Now, let's go to the balance sheet and really look at these, other than accumulated depreciation, look at all these other balance sheet accounts. What do they all have in common? Let's stop and think about it. What's the common factor of all of these accounts? So let's think about, well, how are these classified on the balance sheet? Accounts receivable, that's a current asset. Unearned revenue, usually a current liability. Inventory, current asset. Accounts payable, current liability. Prepaid rent, usually a current asset. Accounts payable, current liability. Interest payable, current liability. Income taxes payable, current liability. So all of those balance sheet accounts that are related to the income, revenue, and expenses that become cash flows, again, that will become a cash flows, those are all current assets and current liabilities. Well, those are often referred to as working capital. So that's our current assets. Actually, working capital actually is when you take current assets minus current liability just to see, hopefully it's a positive number that, we have more current assets and current liabilities, so that's a positive thing in working capital. Okay, so back to our converting net income to cash from operations. So now we can see, we take net income, remove these items. Step number 4 is then going to look at the changes in these, we're just going to net it. We're not going to weave it like we did with the direct method. We're just going to do the shortcut. What were the changes in the current assets and current liabilities? Then that will leave us with cash from operations. Okay, so that's the big picture. All right, let's go back to our spreadsheet over here. And I think I'll just do this in black. Okay, so so down here now I've got for the indirect method what's it going to look like. So let's go through our steps. Step number 1, we start with net income. Well, I'll go to retained earnings to get net income. That's $9,300. And I'm going to put it on the positive side, right? Because it's positive. So I take net income. Now, if you want to do debits and credits here, you still can. I'm debiting cash indirect and crediting retained earnings. So I see there's a debit credit. Step number 2 is to remove non-cash stuff. Well, that's this depreciation expense. So again, take net income. We're going to add back depreciation expense. And again, I got to add it back, so I'm going to put it here on the debit side. Now, I still can do debits and credits, but you'd have to recognize, it's this 670, look down here, this 675. So I have a debit and a credit. So you still can kind of make the debit and credit work here on the indirect. Number 3. Now you'll definitely, now we didn't have any number 3. Let me get rid of that. So we didn't have number 3. So we don't have any gains and losses, so let's just move on to number 4, the changes in the current assets and current liabilities. So, all right, so here I'm only going to look at the change. Accounts receivable went up $9,400. That is on the debit side, okay? Since it's on the debit side, I'm going to put it down here as a credit. And I'm going to also describe it as an increase in accounts receivable. So I have a debit and a credit. And it's going up, just briefly, I'll try to show you what's really going on. Within this net income number is our sales. So there's sales of $48,000. Now, in the direct method, we kind of weaved it through, we recorded it, and it's all for cash flow. The account actually went up $9,400. And so if I subtract that increase, I will get my $38,600, which is my cash flow. So the indirect method is doing the same sort of thing, only it's doing a shortcut. And we could have done this with the direct. I could have credited $48,000, do some sort of debit over here for $9,400. So I'd have a debit of $9,400 and a credit, excuse me, I'm saying that wrong. So credit to sales, $48,000, debit $9,400 here, and debit cash over here for $38,600. But I don't want you thinking of it that way yet with the direct. I really want you to reinforce sales cause accounts receivable to go up, cash flow causes it to go down. It's in the indirect method that we'll just do the shortcut way of doing it. So again, it's just converting it within that number, the $38,600. Okay, the next one is inventory. Inventory went down. That is a credit. So that's on the credit side. I'm going to put it here on the debit. And again, that is a decrease in inventory, INV. I'm just going to abbreviate that. So I have a credit to inventory, debit cash down here, decrease inventory. Prepaid rent also went down. That's on the credit side. So I have a credit, put it over here in this T account as a debit. A decrease prepaid rent. I'm just going to put PP for prepaid rent. So I have a debit of $500, a credit to prepaid rent. And again, I could do the same thing. We have rent expense of $500, right? $500. And in essence, and by the way, that's a negative for net income. So rent expense reduces, right? We would have subtracted that to arrive at net income. So I'm going to add the change in prepaid rent, $500, just like I'm doing in my T account, and we get 0 cash payment. So again, rent expense on the income statement, I put it as a negative because it's subtracted on the income statement. I'm going to add in the decrease in prepaid rent because I do it here. I'm adding it to net income over here. So add it, and we get 0 cash payments. So we're just, going step by step here, kind of like we would have done with the direct method. Okay, also interest payable went down. That's on the debit side. So I'll put it over here as a credit. So decrease interest payable. Nothing happened to unearned revenue. Accounts payable merchandise also went down. That's on the debit side. So put it over here on the credit. So I have a debit, credit for a decrease in accounts payable merchandise. Accounts payable services went up. That's a credit. So since it's a credit, put it over here, down here in the T account as a debit. So I have an increase. I have an increase. I'm adding an increase in accounts payable services. Debit 2181, and then the credit over here. Current portion of debt, it is a current liability, but it's not an operating activity, right? It's a financing, so I ignore it. Taxes payable went up. That's on the credit side, so put it over here. Oh, messed up, didn't I? It's on the credit side, so let's put it over here on the debit side. Increase in taxes payable. So I have a debit and a credit. So then back over here on our, so let's see, and that's everything. It's all our current assets and current liabilities. So take net income, add depreciation expense, add those 4 items. Check this real quick. Yep, add those 4 items, 675, 500, 5,000, 21 in that, and subtract these 3, and we will get cash from operations, $12,551. And those should agree, and they do. Okay, and that is exactly, we can go back and look that on our cash flow statement, right, that's exactly what we had. So I could take that T account at the bottom and take net income, add depreciation, add these items in, and notice it shows whether it's a decrease or an increase. Go to, the other side of the T account, subtract those items to get our $12,551. Okay, that's it for this recording. I also will I have another recording just to get you started with March MixMax. And then, so there's going to be a part A for March and a part B to actually show you the solution. March MixMax is a little different, and so I'll have a separate recording for that.